India's green energy infrastructure is expanding at a massive scale, with vast solar farms now covering landscapes that were empty just a few years ago. Waaree Renewable Technologies sits at the center of this boom. As a 1,146 crore rupee mid-cap firm, they handle the heavy lifting of engineering and construction for these massive solar projects. They operate with a built-in advantage as part of the Waaree Group, which is currently India's largest manufacturer of solar modules. This structural lead has translated into massive growth, with quarterly sales figures hitting triple digits and drawing aggressive interest from the market. But for anyone looking to buy in now, there is a serious risk of entering at the absolute top of a cycle and getting caught in a valuation bubble. This dashboard highlights a specific mathematical red flag. The Graham number, a defensive measure of intrinsic asset value, is just 304 rupees, yet the current market price is sitting nearly 4 times higher at 1,116. Today, we have to determine if that massive premium is the fair price for elite market leadership or a trap for retail investors arriving late to the story. Momentum investors prioritize the velocity of year-over-year operational scaling over the value of static assets. The data supports this focus. Over the last 3 years, sales have grown by 112%, while profit variance has kept pace at 105%. That growth is actually accelerating right now, with the most recent quarterly sales variance climbing to 131%. Business operations scaling at this speed tend to attract institutional capital, which provides the fuel for rapid stock price appreciation. However, this creates a priced-for-perfection scenario. When expectations are this high, missing a quarterly estimate by even a small margin can lead to a sharp correction. In the solar construction business, something as common as a supply chain delay can cause the market to sell off aggressively. Buying into Waaree today means you are buying pure momentum, and that requires a high tolerance for sudden volatility. Beyond the headline growth, we need to look at operational efficiency, specifically how well management generates profit from the capital they use. The dashboard shows elite efficiency. The return on capital employed is 83.6%, and promoters have retained 74.3% of the company. Importantly, Waaree has kept their debt remarkably low, at just 146 crores. This suggests a management team that can execute large-scale projects efficiently without over-leveraging the balance sheet. But there is a significant trade-off for investors who prioritize consistent cash flow. In the top right corner, the dividend yield is a microscopic 0.09%. The company is choosing to reinvest its cash into expansion rather than paying it out to shareholders. This creates a dividend desert. Because there is no passive income, the entire value of the investment depends on your ability to time the stock price correctly. This brings us back to the friction we saw earlier, the high cost of the stock compared to its physical footprint. Traditional value investors usually walk away at this point. The price-to-book value of 12.5 means you are paying over 12 times what the company's physical assets are worth. Buying at this level requires total confidence that the future order book will be worth the steep entry price. Growth-oriented investors, however, look at price relative to the velocity of earnings rather than just current assets. Compared to the sector, Waaree looks relatively inexpensive. Their PE ratio of 24.3 is lower than the industry average of 28.3. The PEG ratio provides more context. At 0.23, it suggests the stock is underpriced relative to how fast its profits are compounding. Waaree represents 2 different stories. It is expensive if you are buying for the assets they own today, but it is an attractive entry if you are buying for the earnings trajectory they are currently maintaining. Now we move from analysis to a specific portfolio playbook. Deep value and income investors operate on strict requirements for dividends and tangible assets. For this group, the verdict is a clear avoid. The high price-to-book ratio and negligible yield violate the core principles of a value-first strategy. For aggressive growth, or GARP investors, the outlook is different. In this case, it's a buy. The market hasn't fully priced in the combination of elite capital efficiency and a PEG ratio well below 1. Since the stock is trading at a discount to the industry average despite its faster growth, the current price of 1,116 rupees represents a defensible entry point for a growth-focused portfolio. To set an upside target, we look at the previous high of 1,358 rupees shown at the top of the dashboard. Given the 131% surge in sales, targeting a breakout toward the 1400 to 1450 range is a reasonable goal for this momentum. To manage the inherent risks of the solar sector, a strict stop-loss at 950 rupees is necessary to protect against sudden volatility. This is your trading playbook for Waaree Renewable. Waaree is a high-performance growth play. Use it for its momentum, but not as a safety asset. Trade it with discipline.